Long-lived assets, also known as non-current or long-term assets, are assets that offer companies economic benefits for more than 1 year. These assets can be divided into tangible, intangible, and financial assets. Tangible assets, also known as fixed assets or property, plant, and equipment (PPE), are assets with physical substance, such as land, buildings, furniture, machinery and vehicles. On the other hand, intangible assets have no physical substance and include patents and trademarks. Long-lived financial assets include equity and debt securities issued by other entities. In this video, we will focus on the accounting for tangible assets, particularly those that are acquired. So how do we deal with tangible assets from an accounting perspective? A firm can acquire PPE either by direct purchase or by swapping assets with other parties. If the asset is acquired through an exchange, it is recorded at its fair value if this value can be determined reliably. If not, then at the fair value of the asset that was given up. If neither of these values can be determined, then it is recorded at the carrying amount of the asset that was given up. When accounting for the asset exchange, the carrying amount of the asset given up is removed, and the fair value of the asset acquired is added. If the fair value of the newly acquired asset is larger than the carrying amount of the asset that was given up, a gain is reported, and vice versa. When acquired by purchase, fixed assets are reported at cost, which is their fair value. In addition, as part of the asset's total cost, the buyer includes all the expenses necessary for getting the asset ready for its intended use, such as the costs of transportation, installation, and testing, incurred by the buyer. An important distinction to make here is between costs that are capitalized and those that are expensed. Any costs that are expected to benefit the firm for a period beyond 1 year are capitalized, meaning they are recognized as an asset, or part of the asset, on the balance sheet. The other costs are expensed, meaning that they are recognized as expensed on the income statement of the same period. Generally, expenses that extend the asset's initial life are capitalized. Let's look at an example. BCC Inc. purchased a machine that costs $10,500 including taxes, and incurred $290 in shipping fees, $390 for installation and testing, and $150 in training fees. BCC also incurred $1,640 for plant reinforcements to better support the acquired machinery. In addition, $500 was paid to fix a leak in the plant walls, which is expected to increase the useful life of the plant by 3 years. Also, $1,055 was paid for renovating the CEO's office, but this is not expected to extend the plant's life. Now let's determine which of the expenses incurred will be capitalized and which will be expensed. All the costs necessary for getting the new machine ready for its intended use will be capitalized. These include the purchase price, shipping fee, installation and testing fee, and the cost of reinforcing the plant to better hold the new equipment, as well as the cost of fixing the walls since it extends the plant's useful life. On the other hand, the costs to be expensed are the training fees, which are not necessary for the machine to function, and the costs related to the office renovation. So, the capitalized cost of the machine will be $10,500 plus $290 plus $390 plus $1,640. The total of $12,820 will be the machine's carrying amount on the balance sheet and will be recorded as an investing activity on the cash flow statement. The $500 incurred for fixing the plant walls will increase the carrying value of the plant asset on the balance sheet and will also be reported as an investing cash outflow. The expensed fees of training and office renovation will be reported on the income statement, subsequently decreasing the company's retained earnings on the balance sheet, and will be categorized as an operating cash outflow. Find the full accounting for tangible assets video on www.cognivisio.com.